Hey there, TaxBots. I'm Justin Spicer from Legal Aid of Southeast and Central Ohio, and I'm here with two attorneys from our tax team, Kathy Hoover and Luke Minek. Today, we're continuing our self-employment and small business series, and we'll be talking about the different types of businesses you can operate and the tax liability of the business owner. Feel free to leave a comment or a question below, and we'll answer whatever we can. Kathy, to get us started today, can you give our viewers a quick overview of what we're going to be talking about?
Of course, when you start your small business, you'll need to decide how you want to structure your business. Choosing what type of business structure is best for your small business involves two related decisions. The first is how is the business going to be taxed, and the second is who's the liability of the business owner.
Luke, what does that mean? What is liability?
So liability means who has financial responsibility for business debts if the business goes out of business or if the business is sued.
So what are the different types of businesses that I can operate?
So there are four business structures that individuals can choose to operate their business under. Sole proprietorship. Second is the limited liability company, often called an LLC, a partnership, or a corporation. 90% of small businesses choose to either a sole proprietorship or a limited liability company. So we'll talk about those two options first.
Okay, great. Luke, let's talk about the first option Kathy mentioned, the sole proprietorship. What is that?
So a sole proprietorship is the simplest type of business entity. So this structure is owned and operated by a single person, and it's the simplest, low cost, and fast and easy to set up. Unlike other options, no separate legal entity is created. A legal entity means any company or organization that has legal rights and responsibilities separate and apart from the owner. Most people working for themselves would be considered sole proprietors.
Now, if my sole proprietorship was sued, who would be liable? The business or the individual?
So the sole proprietor has what's called unlimited liability. That means that any lawsuits against the business put the business owner's assets, meaning their personal money and property, at risk, and vice versa.
How is the sole proprietor taxed?
So the sole proprietor reports their income, like their W-2 income and retirement distributions, on their individual tax return, their Form 1040. They report their income and expenses from the business on what's called a Schedule C. The Schedule C is included with the owner's Form 1040.
So, Kathy, what's the difference between a sole proprietorship and a limited liability company, which was the second type of business structure you mentioned?
So a limited liability company, or LLC, is a legal entity created under state law. One benefit to structuring a business as an LLC is that the owners are protected from the liabilities of the business, which means that if the business got into debt or is sued, your personal money and property are protected.
Luke, how do I create an LLC?
Well, first you need to choose a name for the LLC. And to do this, you need to search the Ohio Secretary of State's website to make sure that your proposed business name has not been used. And you can find this search tool by visiting www.ohiosos.gov/businesses and click the business search. The name of your new business needs to be different from other businesses registered in Ohio. So think of the name of an LLC like a phone number or an email address. Only one person, or in this case, a business, can have that name. Also, the name of the business has to end with either limited liability company, LLC, LTD, or limited. For instance, your name might be Great Plumbing LLC or World's Best Tacos LTD. You'll need to complete a form with the Ohio Secretary of State's office and pay a filing fee to create your business. You can do that at bsportal.ohiosos.gov. If you happen to live in another state, visit your Secretary of State's website for their specific state information.
Kathy, how is an LLC taxed?
So a single owner LLC will report their income on a tax return just like a sole proprietor. The income and expenses of their LLC will be reported on a Schedule C and included with their Form 1040. The same thing happens for a multi-owner LLC, but each owner will report their income based on their share of the business and file their own tax return, along with the business information return that we'll discuss in a moment. However, the nuances of a multi-member LLC are beyond the scope of today's presentation.
Luke, the third type of business structure Kathy mentioned was a partnership. Is a partnership the same as an LLC?
Not really. So, unlike an LLC, a partnership is a relationship between two or more people who come together to start a business. and so there's no separate legal entity created. Each person creates or contributes money, property, labor, or skills, and they each expect to share both the profits and the losses of the business. Any number of people may join in a partnership.
So like sole proprietorships, if the partnership is sued or can't pay its debts, the partners are each fully liable or responsible for that debt.
Luke, how is a partnership taxed?
So the partnership must file an information return. An information return simply reports the income, deductions, gains, losses, and so on from the operation, but it does not pay income tax. Instead, profits and losses reported on the information return are then reported by the partners on their individual tax returns based on their share in the business. If you do decide to form a partnership, make sure you have a good accountant and tax preparer who has experience with partnerships.
Kathy, what about a corporation, the fourth business structure you mentioned? What are the benefits of setting up a business as a corporation?
So like an LLC, corporations are treated by law as legal entities. That means the corporation has a life separate from its owners and has the rights and duties of its own. The owners of a corporation are known as shareholders. Forming a corporation involves transferring money, property, or both by the shareholders in exchange for shares in the corporation. In other words, the shareholders buy these shares in the company. The shareholders would get their share of profits when they are paid by the corporation as dividends. Dividends are generally paid on a regular basis, and they are one of the ways investors earn a return from investing in shares. Nowadays, these dividends are generally paid via direct deposit to shareholders.
The other
So,
benefit of setting up a business as a corporation is that, like an LLC, the shareholders are not personally liable for the debts of the corporation. Instead, the corporation is liable for the debt.
okay. Kathy, how is a corporation taxed?
So the profit of a corporation is taxed to the corporation when it's earned, and then is taxed to the shareholders as well when distributed as dividends. The corporation will need to file its own annual tax return, and the taxation of the corporation can be very complicated. So make sure you have a good accountant and tax preparer who has experience with corporations.
Awesome. Thank you so much, Kathy and Luke, for the great information as always. And thanks to everyone for tuning in. Join us next time on August 23rd when we will explain how to check the status of your tax refund. Remember, you can find this segment on our Facebook page and past tax chat videos on our YouTube page. Thanks, everyone, and we'll see you next time.